The solo 401k has a bit of an odd history. Hi, I'm financial planner Sean Mullaney. Let's discuss. So these days, for many self-employed people, the two main retirement accounts are the SEP IRA and the solo 401k. Well, let's think about somebody self-employed, Schedule C income, right? So they file a Schedule C that goes on the tax return. It reports about $100,000 of self-employment income. They use a SEP IRA. They can get $18,500 little change in as a SEP IRA contribution, tax deduction, building up $18,500 of tax deferred wealth. Okay, that's pretty good. What if they use a solo 401k instead? Well, the number goes way, way up. It goes up to over $39,000 because the solo 401k has both employee and employer contributions. So you're telling me for many Americans, the solo 401k could mean more than double the contributions than a SEP IRA and more than double the tax deductions. Well, why the heck then is the SEP IRA still so popular in the year 2022? Why do so many self-employed people have no idea about a solo 401k? Well, it has to do with some tax history. Let's go back in time. Travel back in your mind's eye to pre-2001, so over 20 years ago. Back then, the solo 401k existed and the SEP IRA existed. But the way the limits worked, practically for most Americans, the SEP IRA limit and the solo 401k limit were roughly the same. And so there wasn't that much of a distinction between SEP IRA versus solo 401k in terms of limits. And then you have to say, well, okay, if there's no difference, which one do I contribute to? And the big thing was deadlines, right? So back then, and today, by the way, SEP IRA, you can establish and fund up to the tax return filing deadline. So if you file an extension beyond April 15th, you have so much time after the year closes, not only to fund the SEP IRA, but to even establish it for the previous year. You don't have to act by New Year's Eve. It was such an user-friendly experience pre-2001 SEP IRA. Pre-2001 solo 401k did not have that user-friendly experience. In order to fund a solo 401k for the year before 2001, it had to be established by December 31st of the year you were looking to fund, right? So if you're doing your tax return, you're like, oh, I had $100,000 of self-employment income last year, and I didn't establish anything last year. I was busy running my business. I didn't do any tax planning. During tax return season, you could do the SEP IRA, easy peasy. You could not do a solo 401k. So guess what happened, right? Tax practitioners, financial planners, and even the financial institutions, they just got into the habit of, oh, SEP IRA, SEP IRA, SEP IRA. And there was really no detriment to clients to do that because the numbers were about the same. In many cases, they were exactly the same in terms of limits. And we had all this time after the year closed, during tax return season, we get that thing established and funded, no problem, no foresight needed. And because of that, the financial institutions themselves, the brokerages, all biased towards the SEP IRA. And back then, rightfully so, right? If we can have all this additional flexibility, why go with a solo 401k when it's so much more rigid in terms of getting it established on time than the SEP IRA, which was so easy? Okay, so that's the lay of the land before 2001. Clearly, the SEP IRA was just better for most Americans and easier to implement, and the financial institutions got very much behind them. Okay, what happens in 2001? Well, the 2001, George W. Bush becomes president of the United States, and the Republicans have narrow majorities in the House and Senate, and they're big on tax cuts, right? That was the politics of the era is tax cuts. We've got to do tax cuts. And so in 2001, they passed a very large tax cut bill. It was a very extensive bill, and it has things we enjoy to this day. I believe that's the bill that established the 10% tax bracket, had big tax cuts for many Americans, right, in terms of rate, right? So that was the headline, like all these tax rates are coming down. That's the big headline in the media. But there were other goodies in there. There was the 0% long-term capital gains rate. Capital gains taxes came down. Qualified dividend income became a thing in 2001, right? Back in the day, it was dividends were ordinary income. 2001 and beyond, they're tax favored income. So that was a big development. Got a lot of press back then. And they increased the contribution limits for IRAs and Roth IRAs. They'd been stuck at $2,000 for the longest time, and they got indexed for inflation and increased in the 2001 Tax Act. So there was a lot of personal finance media back then, but we didn't have YouTube, we didn't have podcasts, we didn't have Twitter. That media focused on those three things, and rightfully so, because they were very impactful for many, many Americans. But that 2001 Tax Act snuck in a interesting provision for solo 401ks. It said for the solo 401k, guess what we're going to do? We're going to let you make both employee and employer contributions to the solo 401k. We're not going to change anything in terms of deadlines, but for the solo 401k, you can now do both the employee and the employer contribution, and you don't have to worry about the employee contribution diminishing the employer contribution, nothing like that for the most part. And so guess what? The numbers changed in 2001. The numbers went to saying, for many Americans, not the wealthiest, but for many Americans, now the solo 401k actually lets me get more into a retirement account than the SEP IRA. But the world didn't change overnight. You got to remember a few things still were true after that 2001 Tax Act. One, the deadlines were still the same. The SEP IRA was still so much more user-friendly from a deadline perspective. Tax return preparers didn't have to call their clients before the end of the year for a SEP IRA. They would have for a solo 401k. And you got to remember too, 2001 was a very different era in terms of media, in terms of personal finance media. We didn't have independent content creators for the most part. A lot of the media was driven by the networks, the Wall Street Journal, the magazines that dominated in the personal finance space. And they focused on the things that had the broadest applicability, right? Tax rate cuts, expanded IRAs and Roth IRAs, qualified dividend income, lower capital gains tax rates, right? So those things were just more prevalent and had a lot more juice in terms of that 2001 Tax Act. So this solo 401k change it didn't fall by the wayside, but it didn't get that much attention. And the SEP IRA was still the go-to for tax return preparers. It was still sort of the go-to for the financial institutions. They had so much history with them. The solo 401k still required that planning before year end. And at the highest levels of income for the self-employed, the limits were still the same. That's still true today, right? If you're making a ton in terms of self-employment income, SEP IRA, solo 401k limits are basically the same. So for those reasons, the solo 401k just didn't take off. Yeah, I'm sure there were folks using them back then, but especially if you think about tax return preparers, what's better? Do you want to just be able to do it right before you file a tax return? Or do you want to have to do aggressive planning before the year end? Forget tax return season when everybody's focused. You had to do planning before year end. So the solo 401k did not take off. And for many years, it remained that way. Now in 2010, there was an interesting development that started to move the needle a little bit towards the solo 401k. And that was the introduction of the Backdoor Roth IRA. I'll put a link to one of my Backdoor Roth IRA videos in the description, and hopefully right above. I believe it would be above this finger here, hopefully. In 2010, for the first time, folks could do a Backdoor Roth IRA. And for the first time, the SEP IRA, even for the wealthiest self-employed folks, had a real drawback, right? One of the drawbacks of the SEP IRA is that it, generally speaking, precludes any sort of tax advantage backdoor Roth IRA. You can still do the steps, but it's generally going to create a mostly taxable transaction in most cases. Just not really good tax planning. The solo 401k allows the backdoor Roth IRA. It shields retirement savings from the pro rata rule, right? So this was an interesting development. And in 2010, by the time 2010 comes around, the personal finance space is growing. Twitter's now a thing. Not that the solo 401k took off overnight, but it was sort of an interesting development. Some practitioners started thinking and saying, oh, that's interesting. A SEP IRA creates a pro rata rule problem, which starting in the year 2010 was a real problem. Before 2010, you generally couldn't do a backdoor Roth IRA because there was a constraint on the ability to do Roth conversions. Back then, there was an income limit, and basically, if you were a backdoor Roth IRA candidate, you probably couldn't do a Roth conversion before 2010. So it's an interesting development, but even then, inertia is a powerful force. And, even going forward, right, you still had all the financial institutions were still jazzed up for the SEP IRA. The tax return preparers were still jazzed up for a SEP IRA because you didn't have to do planning before year end. You didn't have to get that solo 401k established. But now we've got better contribution limits. We've got backdoor Roth IRA optimization on the solo 401k side. And then in 2019, there was another development that was very favorable for the solo 401k. That development is the changing of the deadline to establish a solo 401k, but only for employer contributions. So the Secure Act gets passed in late 2019. And one of the things it does is it says, okay, you can have a SEP or a solo 401k after year end, you can establish it and still do the employer contribution only for the previous year. You can't do the employee contribution, but you could do the employer contribution. And so that made the solo 401k at least a little more user-friendly. For 1 year, it means you could get the same amount in as a SEP IRA. Still, the planning is up front is much better, but at least we're getting closer. And interestingly enough, the Secure 2.0 Act in 2022 has only passed the House, has not passed the Senate yet. It has Section 321 in that bill. And that would allow after year-end establishment for the first year only for employee contributions too. So it would make the solo 401k even a little more user-friendly. So even with all that, so many people are just SEP IRA, SEP IRA, SEP IRA. It's what we've been doing for 30 years. Let's keep doing it. And my thesis is for many Americans, no. The solo 401k is the preferable option because it has so much more flexibility in terms of contributions and limits. It allows for Roth employee contributions. The SEP IRA allows for no employee contributions, Roth or traditional. So my hope is that as folks learn, there'll be a lot more adaptation of the solo 401k by solopreneurs and financial planners. Tax return preparers will get past that inertia and say, oh yeah, you ought to be doing upfront planning, get that solo 401k established by year end, and now you have a lot more flexibility in terms of contributions. Hope you liked this video on the odd history of the solo 401k. If you did, please mash that like button and subscribe to my channel. I'll see you next time.